Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is Tuesday, January the 23rd, and we have Brent crude oil with its head popped above $80 a barrel. That treasured $80 the first time this year, and it would appear slowly but surely this oil price is incrementally being pushed up by ultimately to identify the ongoing uncertainties in terms of the Red Sea and the shipping lanes and the growing disruptions there. At least that seems to be the momentum. Let's kick off with Max Torres, managing partner at Plata Energy. Max, what do you see as this upward momentum? Slowly, it's been sort of caught in a 70s, mid to late 70s sort of pitch, but now incrementally going upward. What do you think is moving this dial upwards?
Morning, Sean. Thank you for the question. I think fundamentals, I think economics, I think the outlook for the next year or this year, sorry, I think is good. I think the inflation is going to be stable. I think the Fed is going to be, cutting rates. So I think the economic outlook, I think is solid, and I think that's pushing. It's not pushing. Basically, it's been idling between 75 and 80 for a while already, but it's stable, and I think we're going to see stable prices this year, despite all the geopolitical issues. I think we have a lot of geopolitics around, but I think economic fundamentals are good. That's my view, for this year.
Let's welcome Scott Livermore, Chief Economist, Oxford Economics, Middle East. Scott, your thoughts on that? I mean, it does seem that there's a lot of mediocre macro headlines around regarding growth, although Beijing did come out with a slightly higher than last year expected. The growth target for this year a little bit around the same ultimately. But your thoughts of where that macro picture is, and is that the driver? Is that where the market's going to find direction from the macro outlook?
Yeah, hi, Sean. And I think I probably agree with Max here. I think it's probably too early to call that oil is breaking into an upward trend. And the market continues to be concerned about the demand outlook. But you're right, the news is slightly more positive than we had been expecting. Us at Oxford Economics have recently revised up our forecast for 2024 at the global outlook. And in particular, the US is looking slightly stronger than we were expecting at the end of last year.
What was your revision from what to what?
So we've pushed up global growth to 2.3% for 2024. Global GDP growth, that is, from 2.1% previously. And that's predominantly on the back of the US. The US has strong momentum going in at the turn of the year, supported by a strong consumer. But I think why the good news is recession's likely to be avoided. We still expect a slowdown, but that slowdown's likely to be a soft landing in the advanced economies. You're going to see a running out of the momentum of the excess savings we've seen in the US that have been running down to support consumer spending. There's a concern that the monetary tightening may be passing through slower than we'd seen in previous cycles. So that will kind of weigh on growth going into 2024, even if monetary policy is reversed. And in most of the developed countries, fiscal policy is likely to be contractionary, hold growth back. And as you mentioned, Shul, China, the growth target was probably higher than we were expecting, the 5% they're targeted for 2024. That still seems slightly ambitious. And policy is going to be much more focused in China about supporting rather than boosting growth. And that means why we're slightly more positive about growth now. I don't think the worries have completely dissipated. And like Max, we expect oil probably to move sideways during the course of the year.
Let's welcome to the table David Elward, Senior Pricing Analyst at General Index. David, your thoughts on where this is impacting the products? So we're seeing obviously a lot of talk about crude with the disruptions in the Red Sea, but we're starting to see cargo rates, tanker rates being impacted, and the products. Where do you think the impact and the connection is with this geopolitical strife in the Middle East and its impact for product prices?
Sure, thanks, Sean, and good to be with you today.
Pleasure.
I'm gonna put a spotlight particularly on one product, jet fuel. This is one product that is very reliant on the shipping routes that we're talking about through the Red Sea, and pricing on jet fuel is particularly bullish among refined products at the moment, with the aviation fuel market, like many others, falling foul of the transit disruption in the Red Sea. Now, we keep an eye on some of the dynamics in terms of trade flows, and we could see that there is expected to be a sharp fall in jet fuel cargoes, which loaded east of Suez this month, transiting Suez. And that means more charterers are deciding to bypass the Red Sea, instead being sent around the Cape of Good Hope. It's a bit of an art rather than a science sometimes, vessel tracking, but we can be pretty clear that jet fuel shipments are not immune to the disruption around the Bab el-Mandeb Strait disruption, and prices have risen accordingly. Jet fuel in Europe currently up around $115 a barrel. That's a lot stronger, about $5 a barrel stronger than diesel. So it's right out in front at the moment and bearing the brunt of some of this disruption.
Max, the big question, I mean, from point of view of this market being one, supply and demand fundamentals. I mean, the OPEC Plus worked very hard last year to try to keep that tightness in the market as the sort of draft was downward, and ended the year with over 5 million barrels of idle supply, while the Americas, the Latin Americas and the United States added supply and continued to do so. Do you think that will remain a challenge for OPEC Plus this year? Your outlook for the Americas, if you like, in the year ahead, and particularly welcome your insights with the new government in Argentina.
Thank you, Sean. Great question. Indeed, I think Latin America is going to be adding supply. I think many fronts. I think Guyana, Exxon is doing great work. Is adding discoveries, adding production. Brazil is near, not near, is at 4 million barrels of oil per day, equivalent, which is a huge number. And US is at all-time records. So I think, yes, to answer your question, we're going to be seeing from the Americas in general, we're going to be seeing adding, supply. With respect to Argentina, I think we are starting a new cycle here with President Milei. He is bringing a whole new philosophy, let's say, about how, government and, the capitalism and, how the country should behave, in the Western world. Argentina has been, awful in the last 20 years as far as, economics. Inflation is near 200%, last year. So basically, he's trying to introduce this new decree, which is a very ambitious decree, changing a lot of laws and regulations, for this year. In the oil and gas front, there were many talks about, the privatization of YPF, which probably is not going to happen. I think that's going to be a tough sale. So I don't think they're going to privatize.
Does he have the
YPF.
authority to do that? Does he have that in his decision-making power to privatize YPF?
Well, the state owns 51% of still owns 51% of YPF. So he could, in theory, sell the 51% going through Congress and going through the whole red tape. He could do that. But apparently that's been postponed and is not now part of the plan. He was very aggressive in his campaign about privatizing, all state-owned companies, everything. So basically, I think YPF is going to put people on hold. Anyway, I think we probably are going to see a wave of investment in Vaca Muerta. I think we're going to see new companies coming in. Recently, I was, listening or talking to people about Aramco, landing in Vaca Muerta and doing some trading here as well. And news about a new play, which is called the Palermo Aike. That's in the southern part of Patagonia. Those new wells being drilled by YPF and a company called CGC. So that's a new play. That's an unconventional play. That's completely new. Partly, good results. So Argentina, I think. Yeah, go ahead. Sorry.
There's a lot of potential there. Maybe not immediately, but Scott, looking at the challenge on the supply side coming out from the non-OPEC plus countries, as we said, in the Americas, most notably last year, well over 1 million barrels added last year from non-OPEC, from including the US. The challenge that presents to the Middle East economies, particularly Saudi Arabia. Your thoughts on where the Saudi economic transformation momentum is challenged by this and their need for a higher oil price? How much can they do to sort of counter this development? Obviously, last year they did what they could. The outlook this year for Saudi and how important it is for the momentum of the economic transformation of the kingdom.
As you say, it's kind of critical to the region. I think on the whole, the public sector balance sheets and the finances of the government are still in a relatively good position. So oil at its current price, production how we expect to go through, probably means the Saudi budget is in slight deficit in 2024, UAE in surplus. But as we know around the world, budget deficits aren't unusual. Saudi doesn't have a significant debt level. It's got an accumulation of assets. So it's not in a situation where the current state of the oil market or even slight downsides looking forward calls into question its ability to pursue its growth and diversification agenda over the next year. So we expect the authorities to continue quite strongly pushing forward with Vision 2030. It's got some very public evaluations come Expo 2033, Football World Cup 2034. So that really shows a sign of commitment to this transformation. And we expect the Saudi economy to push forward. We're likely to see non-oil GDP growth around 5% again this year, which is strong, especially when we consider what's going on in the rest of the world. Headline GDP is likely to be bounced around with whatever happens to oil production, but that shouldn't blow the non-oil economy off course.
The situation looking forward in terms of where we're going in the jet fuel market, which you mentioned earlier there, David, it's obviously aviation and jet fuel was the big laggard recovery from COVID, and China still catching up on where its pre-COVID aviation fuel demand was. Where do you see in this last year, we start this new year, 2024, first time where we've an extra 1 million barrels a day of refining capacity here in the Gulf, with this new opportunity in Europe due to the embargo on Russia and so forth. How do you see that playing out? Still weaker aviation demand in China, European opportunity for the Gulf refiners. What impact does that have, do you think, will have on flows of high-value products like aviation fuel and others as we go into the new year?
Yeah, it's a good question, Sean. I mean, Europe and many other consuming destinations have been highly reliant on producers in the Mideast Gulf. That is going to continue in the short to medium term. You mentioned demand has certainly been bringing up the rear in terms of the recovery post-pandemic in the aviation space. Some of the demand data points on that in terms of air traffic are more positive. We seem to be getting there, i.e., to pre-pandemic to 2019 levels in some markets. It's taken a little bit longer in others. You mentioned China to fully reach that recovery. Look, we're entering a period now which, from a west of Suez perspective, it is not typically the strongest demand period, and so if there is a drop or some of this disruption that's going on can be somewhat absorbed, given that the demand is a little bit softer. We see supplies are lower, resupply coming from east to west, but that is not atypical for this time of year. We may see some.
I suppose that's the point, isn't it? What's typical anymore when these new flows are moving west to east, and now we're seeing east to west. These are not typical times in the context of the backdrop of the Russian invasion of Ukraine and all of these new flows moving in different directions.
Yeah, that's true. I mean, the market had like a substantial period of readjustment, not just on jet fuel, but on diesel over the last 12 to 18 months in the wake of the sanctions by the West on Russian oil, and diesel, perhaps much more so than jet fuel, was the casualty there. But we've seen a real substantial reorientation in those supply flows. We'd expect for the Mideast Gulf refiners to continue to send a lot of diesel west. I guess just one other thing to keep an eye on: the market has been waiting with bated breath for quite a while. The arrival of the Dangote refinery in West Africa, that has now started.
Waiting for Godot, I think, more or less, that one.
That has now started to produce some jet fuel and diesel. So I know many here in Europe are looking at the arrival of Dangote in Nigeria, upwards of 600,000 barrels a day capacity, as a disruptive force within the gasoline space, but it will produce jet fuel and diesel, and so it could displace some cargoes out of east of Suez, out of the Mideast Gulf markets into West Africa as well. So that's one to keep an eye on going forward through this year.
Let's go to the survey question and get some thoughts on that. The point mentioned earlier. The Fed won't cut rates in the first half of 2024. It's this question, as we started out our conversation regarding the macroeconomic outlook, how much wind is in the sails here, and what the Fed will do. We still have inflation up. We still have the unemployment, which is the other half of the Fed mandate. In the US, employment looks like a 50-year low. No reason for the Fed to move. So the question is, will the Fed move in the first half of this year, despite the market's wish or otherwise? That's the welcome thoughts on that. But Max, I wanted to get another view. We mentioned, obviously, in our earlier comment with you, the Latin America outlook and Argentina. But what about the US? I mean, the big addition last year to the shale production, US oil production now near record levels, above 13 million barrels a day. That was a big, if there was one the number of challenges to keeping the markets balanced last year from an OPEC plus point of view. It was the arrival of such a significant amount of shale. You're sitting there in the US. What is the outlook for shale? Do you think repeating what they did last year and adding further supply in the US Permian?
Yes, Sean, thank you. I think we're going to see increased production in the U.S. From shale. That's my view. I think we have seen a great deal of consolidation in the industry, and I think that needs to be paying off. So basically, I think we are for probably bigger, better numbers as far as shale production. So basically, we are going to see on the supply side, we're going to see basically an increase from shale. That's my view from the shale production.
In context of what we saw last year, do you expect similar, more, or less? A repeat of last year would be a massive challenge. I mean, the global demand growth in 2024 is forecast well below 23 levels. Most are averaging between 1.2 to 1.6 million barrels of additional supply. I mean, if the US were to repeat what they did last year, they wouldn't be leaving much room for OPEC plus there.
Oh, I agree. We're gonna see some conflicting numbers, probably through the years, but demand is not strong, but I see, a supply pressure, from the U.S. and also from, as I said, some countries in Latin America. I will probably not discount, Venezuela coming back. We've seen some movements in Venezuela lately, the lift of sanctions, Chevron moving in, Shale recently signed a new contract with Trinidad. I've seen some movements in Venezuela. Pemex was recently last week, signing deals in Venezuela. Small companies signing new deals, in smaller, fields, but with very creative ideas. So I will see probably this year, a renewal of Venezuela, which is going to add pressure on the supply, and I think the U.S. is going to be coming strong, and I think we're going to see some other issues this year, like Venezuela, and maybe Argentina. Maybe if Argentina, things are as we predicted, Argentina also is going to be adding pressure on the supply.
Scott, we talk a lot about the Red Sea shipping lane disruptions, very much from a global trade point of view. Obviously, the US and the UK are taking military action to try and counter the disruptions there. But what does it mean for a regional economic impact? Inevitably, these are trading routes close to the Arabian Peninsula. They are the Arabian Peninsula, if you like. Does it have economic outlook consequences for this region as it drags on?
Potentially, and some areas have affected more than others. Clearly, Egypt is particularly affected with so much foreign exchange derived from the Suez Canal, and the lower traffic going through there hits their revenues, and we all know they're in a precarious situation with the pound under pressure and with IMF bailouts being discussed. So they're most exposed. Looking more directly in the Gulf, there is an impact, particularly because we take a lot of our imports from Europe. So the costs of shipping that we've seen increase will feed through and put some upward pressure on inflation in the region. And clearly, some of the countries we're kind of a trade hub here. So in the sense that ships that may be diverted from Jebel Ali and other ports in the region potentially weigh on some of the activity in those sectors. But at the moment, the biggest impact will probably be through imported inflation and general geopolitical risk that may affect the economy more widely.
And in terms of the oil flow, the direction, I mean, the disruption or lack thereof, do you think have we seen the worst of this? I mean, the impact Obviously, there's many directions that the oil flows, but again, the market does seem to be. I mean, the oil price is telling us, barely as a heartbeat at the moment. It's pretty calm about all of these factors. That its ability to absorb these levels of shock now, shown last year again this year. What's your thoughts on the outlook for that? The macro and the market's ability to absorb these sorts of shocks.
Yeah, well, I think you're right. It's been quite remarkable how sanguine the market's been since the fall, given the turbulence in the region. At the moment, the issues in the Red Sea aren't strictly affecting the shipments of oil, and it seems to be much more the container traffic that's more of a concern, and oil's getting in and out fine. Clearly, if you're looking at a risk and what risk could happen, then more troubles in the Straits of Hormuz could lead to a significant escalation and see oil prices spike up higher. At the moment, markets and us as economists are looking at the situation, assign a fairly low probability to that, but it's something we're watching, and it could be really the big disruptor for the global economy from the crisis we're seeing in the Middle East at the moment.
David, I wanted to get your thoughts on, as one of the other factors we've seen recently since the start of the year and before, but the gap between Brent and WTI moving out to $5 to $6, and what that means in the context to the new pricing within the Brent. Obviously, WTI is now a part of Brent, a big part of Brent. Should that gap not be closer, to be smaller? Why is it so wide? What does it tell us about the Brent contract and the market in Europe, let's say? You're on mute. Sorry, David.
It's a good question, Sean. Look, we can ruminate over the specifics of the pricing. I mean, let's perhaps reflect on some of the wider dynamics. Look, we've been talking about disruption in the Mideast Gulf, but here the biggest price benchmark for oil is kind of independent of all of what's going on there. And look, we've seen over the last year substantial increases of WTI crude being shipped to Rotterdam, which is, without going into the quirks of the price benchmark, but where that crude needs to be sent in order to be eligible. It's been a pivotal couple of years. I mean, perhaps in part we've seen those flows shift due to the ban on Russian oil, but we expect to continue to see those crude shipments move. But also, perhaps I would leave with this, is that we may expect going forward more pressure, more jockeying for WTI alone in Houston as a benchmark to rise in challenge as a challenger to Brent. So one to keep an eye on.
It does appear that in a way, David, the discount of WTI to Brent is creating a real opportunity for increased volumes going into Asia, where we've seen WTI, increase up to close to 3 million barrels a day over last year.
Yes, look, and look, the market is if nothing adept at taking advantage of those kind of spreads, and so long as that incentive is there, then those shipments will continue.
Well, we'll wrap it up there this morning. The Daily Energy Markets podcast, a general agreement, the Fed won't cut rates in the first half of 24. I think the financial markets still seem to disagree with that. Living in hope, I think. My sense is that the Fed would need to see the sort of the white of the eyes of the reason why they should cut rates. They can't just, I think, forward spin this. They'd have to really see tangible evidence to defend cutting rates in the middle of a presidential election. NYMEX trading below $75 a barrel this morning in Asia. Brent crude trading a little bit above $80 a barrel. I think all in all, OPEC Plus will be happy enough with those numbers, and at least from a supplier point of view. We'll wrap it up there. Thanks, Max Torres, Scott Livermore, and Dave Elward. Thank you for your contribution this morning. We look forward to catching up with everybody 10:30 UAE time. All the best.
Thank you, Sean.
Thanks, Sean.
Cheers.
Cheers, Sean.